Stop what you're doing. I need you to listen to this because you're going to thank me. It's something that's going to save you thousands of dollars if you have a mortgage. My name's John Rook, and I was in the mortgage industry for 8 years. And I worked in IT, but I learned about mortgage amortization and the spread between principal and interest over the life of the loan. And there's a secret that no one tells you about, but it's important, and it's important you do this early on in the loan to save as much money as possible. So let me share my screen and I'll show you what I'm talking about. So I am in the Shaggy Blue system. From the main menu, you will see the mortgage menu. I'm going to go there. And this is the screen where you can get an estimate on what the payment and the cash required to close is on the home of your dreams, right? You put in here your income, your credit score, and then what size house are you interested in? Let's say we're interested in a $230,000 home for kicks. We're going to put in the interest rate. Let's say it's 5.2. I'm not really sure what rates are right now, but that's close enough. Let's say you're going to put 20% down, and we're doing this just to find out how much the loan amount would be. Sales price is $230,000, but after the 20% down payment, your mortgage amount will be, let's click calculate, $184,000 is what your mortgage amount would be on that. Now, here's the part that you need to be aware of. We're starting with a loan amount of $184,000, so let's click Generate Amortization Schedule. An amortization schedule is simply a list of all the payments that you will make during the life of the loan. This is a 30-year mortgage, so there's 360 payments in the loan. What this tells you is how fast you're paying down the balance on that loan. And as you've probably always heard, principal is the slowest to come off the loan in the beginning, right? You pay more in interest in the beginning, and then as you go through all the different payments of the loan, eventually you get to where interest is lower and you start kicking in more principal. And this is very true. So in this $184,000 loan, your principal and interest is $1,010.36 a month. That never changes. But when you make your first payment, these are the payment numbers here on the left. When you make your first payment, $213.03 comes off the balance. $797.33 is interest. So your balance only comes down to $183,786.97. On the second payment, principal gets to be a little bit more. Now you're taking off $213.95 from the balance. Now you're down to $183,573.02. The thing nobody tells you is you can make principal-only payments anytime you want on a simple interest mortgage loan. So let's say, for instance, you wanted to pay a little extra on the first payment. Instead of $10,1036, you want to pay an extra principal for payment number 2 and payment number 3. $10,1036 plus $213.95, $214.88. Okay, here's this in an example form. This was payment number 1, $10,1036 plus $213.95 plus $214.88. So you're going to be sending in $1,439.19. And on your mortgage company's website, there's going to be a place where you designate how much you're sending in for the regular payment, and then there'll be a spot where you can include extra principal. So this $213 plus $214 would be where you put the extra amount of principal, which would be $428.83, and you'll make that payment. Here's the beauty, though. After you send that in, you're now going to be ready for payment number 4. You have essentially eliminated the first 3 months on the loan, right? Just because you included the extra principal amounts, you have avoided the interest. You have avoided paying $1,591.89, right? Because your balance came down to $183.58. So on your next payment you make on your mortgage, you're going to be down here. So you've shaved off 3 months on the life of that loan. And you can do this anytime you want. Now, the important thing to remember is don't wait, because as you can see, these principal payments get higher and higher, right? When you get down to like the 15th year, which would be your 180 month mark. Now principal amounts are $461.94 and $463.94, and then they're going up even higher and higher and higher. So don't wait, right? Because it's going to cost you more if you wait. You do it in the beginning. You take advantage of these principal amounts being low. Add on as many as you can whenever you can, and you've eliminated that much interest. Hope this is making sense for you. If it's not making sense, reach out to me. I would be happy to explain this, do another video, break it down, whatever it takes. That is all I can think of right now. I hope this benefits you. Please let me know if it does. All right, thank you. Guys, please use my website. It's free for 60 days. Use all of these tools. Use the amortization schedule. Use the mortgage calculator. Use the car payment calculator. And importantly, do paycheck forecasting. It's all in the website, and you can use any of it for 60 days. No credit cards required. And if you want to continue, it's just $5.99 a year. That's probably less than you spend for a decent burger these days. So give it a try. Thanks.